Now we're going to do the same thing, but we're going to do it with the bear candle signals. And we're going to, exactly the same concept. So here we have black descending. We're going to keep the white real body consistent, and we're going to descend with the black real body. And some of you may recognize these patterns right away. And we're going to go lower and lower. Okay? So same idea as before, but just the flip side. So this is the progression we're going to be looking at. We're going to go from bearish counterattack to dark cloud cover to bearish engulfing pattern to bearish sash to bearish separating line. So the bearish counterattack, opposite of the bullish counterattack, the market is moving higher, white real body. The market gaps higher on the next session, but by the end of the session closes as a relatively long black real body at or near the close of the prior session. All right. Strict criteria, both candles should be relatively long. We want to see a real shift in psychology. The main thing is, however, we want to see a really long black real body because we want to see the market gapping higher sharply and then pummeling back. Okay, and as shown here, the market psychology with a tall white candle, especially with the gap higher the next session, the bulls are happy, are euphoric. And then with the strong bearish counter force, it drags the market down to its prior close, and the tone of the market now shifts from bullish optimism to uncertainty. This is why candle lines, as little as 1, 2, or 3 sessions, are great at revealing the undertones of shifting psychology of the marketplace. I don't use this as support or resistance, and I don't use, as far as support or resistance. However, to me, it would be very positive to close above the high of that black candle. So I would use it as a momentum trade. No 4X, because we have the word gap in there, right? So you don't have this as 4X. And as I mentioned before, to me, what's really important is that black candle. It really should be large. Closes don't exactly have to be the same. And this is the opposite of the bullish counterattack. So here we have a bear counterattack. Okay, well, this is not a bear counterattack, since the closes are not exactly the same. Do you think there's a change in psychology after the session? Sure, definitely. The market, think about it, the prior candle was a white candle. The market gapped higher from that white candle. It closed at 22.5. It gapped higher, it gapped $2.50 higher. And by the end of the session, of the $2.50 gap higher, it gave back about $2. Counterattack with a question mark. Bullish counterattack. Why or why not? Why would it not be? The white real body is not long enough. We want, for the bullish counterattack, at a minimum, we want to see a long white real body because we want to see the market gap much lower on the opening and then come roaring. Remember the kamikaze fight, coming roaring back? And it's the same thing with the bear counterattack. The first candle doesn't have to be a long white candle. The main thing is that second candle has to gap higher and then come falling back. Dark cloud cover, one of the basic candle signals. So the market gaps higher on the opening. Above, this is a minimum, above the prior close. It opens above the prior close and then closes more than halfway into the white real body. Strict criteria. This is where we're going into more advanced. The black candle should open more than open above the prior high. So the basic criteria is the opening here should be above the prior close, but it's more negative if the market moves above the prior high and then comes more than halfway into the black candle. Because what that means is the market gaps higher in the opening, right? It's a higher opening if the market gaps above moves above the prior high than it is if the market moves above the prior close. So that means the market comes down more. So it's stricter if the black candle gaps higher above the prior opening and then comes pulling back. And classic or strict would be both tall candles because you're seeing a shift in psychology from extreme bullishness to extreme bearishness. And the white candle, going with the psychology, the white candle, then a gap higher keeps the bulls happy, but with the black candle finishing well below, remember it has to be below the middle of the white candle, the upward energy, and this is a quote from one of the Japanese books, the upward energy has cooled to an extreme, causing the bulls to become concerned and the bears bolder. And we have the resistance area, the highest high of the dark cloud cover becomes resistance. So whichever has the higher high, in this case would be the black candle, right? Becomes a resistance area, a push above it, a close above it would be a momentum trade. Okay.
Steve, I wanted to get your input on this. The day before, where the white candle, where you had the loss of interest towards the end of the day, that would probably, would you be cautious of the dark cloud cover day because of the way it closed the previous day?
Okay, so question is, we had a bit of an upper shadow. And just to correct thing, we don't know the sell-off occurred at the end of the day. All we know is that the market at some time during the day had rallied up there and then pulled off the lows. We don't know if it's in the end of the day or the middle of the day. But an upper shadow like that, and here you can use my single candle progression. Remember we did before with the single candle lines? This to me would probably be in the between the less bullish and maybe leaning towards neutral area. But this little upper shadow is not that long to get me really nervous. And that's where we would use that candle progression. This is probably, I would say, maybe 25%, 35% of the real body. So this to me would really not get me nervous. And, you know, as you can see with the candle progression, as the real body, as the upper shadow gets longer relative to the real body, I would get nervous. So the long answer to a short question, that first session would not really get me that nervous. The upper shadow is just not that long to really get me nervous. Where I start getting a little nervous if the upper shadow is the same size as the real body. Forex. Okay, here, this would be a dark cloud cover. Same concept, but in reverse with the engulfing patterns and the piercing pattern. Because the opening and closing are going to be the same, this is what it would be like in the Forex market. If the black candle doesn't get more than halfway into the white candle, it's called an incomplete dark cloud cover. And there you should wait for bearish confirmation, definitely. The more the open on the black candle gaps away from the prior high, low close, the better the pattern. And that gets back to the idea of the strict criteria. It's better if the market gaps above the prior high and then comes back. You can't have this in Forex because the market's not going to be able to gap above the prior high. And not surprisingly, this is the opposite of the bullish piercing pattern. For almost every candlestick signal, there's a bearish and bullish counterpart. Okay, this was late 06 in Apple, and we're going to look at Apple again later on. But here, this is a dark cloud cover, almost a bearish engulfing pattern. Not quite, but almost a bearish engulfing pattern. And that defines our resistance area. So for you momentum traders out there, if market gets, and it didn't get above there for a while, but if it gets above that dark cloud cover, that's a bullish breakout signal. Okay, the Euro-US. Okay, resistance zone there. And what I'll do is, if the resistance is very close to one another, levels, I make that a resistance zone. So I'll call this, for example, R1 for our clients. I have R1, R2, R3, S1, S2, F3, resistance 1, resistance 2, S1, S2, and S3, and so forth. So here we have a dark cloud cover confirming a resistance area. And Y, as shown in the blue, or in this case the black text, the blue arrow, why is this not a bullish engulfing pattern? It's either going sideways or maybe up, you know, but either way, it's not a downtrend. So imagine thinking it's a bullish engulfing pattern and buying it here, and we know now, we certainly know it's not a bullish engulfing pattern. Okay, dark cloud cover is resistance here, and we're going to be looking at becoming a market chameleon, adapting to the market tomorrow in one of the sessions. But this is a good example of this. So on the white, see the two red horizontal lines, the market broke above resistance. Okay, assuming it's confirmed by high volume, we have a tall white candle on high volume, it looks good. The next session, anything happen to change our mind? Two things actually. We have the dark cloud cover, and any of you remember one of my techniques I talk about? It's the opposite of the spring or the crack and snap. Falling off the roof, let them climb the roof, and then take away the ladder. The market makes a new high, breaks above a resistance area, and can't hold it. That is normally a very bearish signal. But, of course, if the market closed above the bearish engulfing pattern, the dark cloud cover, it would be a bullish breakout. Okay, crude oil. How many trade futures here? I know we have some futures traders. Okay. Again, everything I'm talking about here could be used in futures. In fact, the original research I did on candles was in the futures markets. Back in the 1980s, I was working at E.F. Hutton. For those who remember Hutton, E.F. Hutton, call it now E.F. Nutton. Okay, that's that classic commercial when Hutton speaks, remember? Everybody listens, it was a great commercial. But I was working in the financial futures department. I was trading Ginnie Mae futures for your old timers out there, T-bond futures, and then I went to work for some other shops, Merrill Lynch and so forth. And the candles became very popular. And my original book, my Japanese Candlestick Charting Techniques, the first edition had only futures charts in it. And the reason for that, in the 80s, when you traded stock, there was no such thing as trading stock in the 80s. You bought and you held stock. There was no trading. This was pre-internet day, folks, you know. So the most liquid, the most savvy technical traders, the short-term traders, were only futures traders. And they were the first to pick up candles. So all my research on candles was actually based in the futures markets. Then in the 90s, with the advent of electronic trading and the internet, we had short-term trading in the equity market. Candles became very popular in the equities market. That's when I focused mainly on equities. And over the last few years, Forex is very popular now. And Forex is great for technicals because I think the highest, and I know for a fact, the highest percentage of technical analysts in any market is definitely Forex. No doubt about it. It's mainly short-term. And how do you follow all the news in the Forex between interest rate relationships, politics, central bank thing, central bank policies? The easiest way to do it is you look at the charts. So that was kind of the progression. So these work in all the markets, I can tell you for a fact. So anyway, this is crude oil, a little dark cloud cover here. And we're looking at momentum now. So here, the market's at resistance. It closed above the resistance area, and I really like this. Why do I like this from the long side? Closed above resistance, what else? A window, right. So now you have two things going on. You have change of polarity, and you have the rising window as support. Okay, so anyway, if you're a momentum trader, as soon as it gaps above the dark cloud cover, which would have been resistance, you then could go on a momentum trade. You buy long on strength, and you'd have a measuring target. You use the height of the boxed range, and this would be a target. Now, somebody asked me before, would I exit at a target? And I had mentioned that the only time I'd use a target to exit a trade would be if I get some sort of confirmation or initiate a new trade, is if I get a confirmation with a candle signal. So here we had a measuring target, and what did we get at the target? A dark cloud cover. What would our potential target be with that dark cloud cover? The gap, and that's exactly what happened. So this is a nice, just brief introduction. We'll look at more as we progress about Western technicals. But we have a measured target confirmed. Actually, it's almost like a gravestone doji, a dark cloud cover confirming a Western target. The support area would be the rising window, and that's exactly what happened. And what did we have here? A bullish engulfing pattern. This is what I mean by east and west. But the thrust of this particular chart is momentum trading. If the market breaks above the resistance area, it's a great trade to go long because you're going with the trend. Here we have a dark cloud cover. Here we don't have a dark cloud cover. Why? Why is that not a dark cloud cover in the... Remember, with the dark cloud cover, where's the black candle have to get into? Halfway, right. And if it doesn't get halfway into the middle of the white candle, we want to wait for a confirmation for it to get below the middle of the white candle, which didn't happen, by the way. Now, this would probably be picked up as a dark cloud cover in the recognition software. But now you have to use your extra insights to think about what this dark cloud cover is saying. Is it enough of a signal to act upon? So, because the black candle get below the middle of the white candle. Yes, but ask yourself this, is there a real shift in psychology? No. So, everybody see that? Does that make sense? Although this would meet the definition of a dark cloud cover, I wouldn't place much emphasis on it. Okay, dark cloud rains pain for the bulls. Okay. Think this stock had problems near 410. First blue candle here, not quite a bearish, not quite a bearish counterattack here, but quite close. Over here, another black candle, a bearish engulfing pattern. What do we have here? And let's think about what happens here. You know, we don't know what happens after. We don't know any of this stuff over here. So forget about this stuff over here. Okay? Happy time for the bulls. The market closed above a resistance area on that white candle. Yes, right? So the bulls are all happy. And the next session, what do we get? A dark cloud cover. Oh, crap. So once again, reinforcing all the problems the stock had at that 410 area. Time after time and time. You know, the candles are telling us that each time, for whatever reason, the bears try to take control near 410. Okay, the bearish engulfing pattern, we can go through this pretty quickly because it's a major signal. We should be familiar with the essentials. Black wrapping around the white. Let's get to the strict criteria. The first candle should be a small or doji, or a small white candle or a doji. And it's better if the second candle, the real body, wraps around or engulfs the entire high-low range of the prior candle. I use the highest high of either candle as resistance. That means if the market closes above it, it's a bullish breakout, and that's a momentum trade. Forex, opening equals prior close, or within a couple of pips. If the real bodies, just kind of flip side of the bullish engulfing pattern, if the real bodies are about the same size, it's not that meaningful. The first candle can be a doji, doesn't have to be a white real body. The candles in an engulfing pattern are opposite of those of the Harajuku pattern. And the last engulfing pattern, we don't have to go through that again. It's just essentially you know that a bearish engulfing pattern has to come after a downtrend, an uptrend. If you have a downtrend, it potentially may not be bearish. So, importance of trend. Okay. These are bearish engulfing patterns because they come after little uptrends. And we know it's not a bearish engulfing pattern because the trend is wrong, right? The trend is, exactly. Okay, here we have a bearish engulfing pattern in the red semicircle, and this looks like a good short sale because it looks like it's tending to confirm the recent highs. And we have the bullish engulfing pattern on the left there with the white candle wrapping around the black real body. Now, the low of the bullish engulfing pattern should be a support level. So, the market did hold the low of the bullish engulfing pattern as support. But let's look at this in a little greater detail. Would you be bearish? So this is a bullish engulfing pattern here. And let's forget about, you sold, let's forget about the fact you sold here and you covered here. It would have been a nice profit. Let's say you're flat. And let's say you went long here. I wouldn't recommend it because there's no bullish candlestick signal. But let's say you like this particular stock and you went long there. We know the bullish engulfing pattern is support. So the low of the bullish engulfing pattern is at $26.10. Wouldn't it be upsetting if you're long on the bullish engulfing pattern and you have a stop here only to have the market come to here and hold the lows from over here? Right? And then rally. So yes, we know a bullish engulfing pattern is potential support, but let's get real. If you have something a few cents away that's another support area, you put a support zone there. So the answer to this is almost all you got was it should be the recent low before the bullish engulfing pattern. If there's a huge range in difference between the bullish engulfing pattern, so say the bullish engulfing pattern is a 2610, and the next support I would have is a 2550, then I'd make S1 and S2, two levels of support. Okay, why is that not a hammer? Okay. It's an uptrend. A hammer has to come after what? Downtrend. Okay, keep your eyes on the screen. Why is that not a shooting star? Downtrend or a neutral range, right? Either way, it's certainly not an uptrend. So those who would have thought this was a hammer would have been buying it here, okay? And those who thought it was a shooting star would have been selling it here. Actually, it was good to hang around with them because they could be reverse indicators. As long as you're consistent, it doesn't have to be 100% right. If you're 100% wrong, that's good to know also. Just do the opposite. Yeah, yeah. Okay, momentum trading. Here we have question.
Do you, as far as an uptrend or downtrend, do you have a minimum number of days required to establish an uptrend or downtrend? 3 days, 5 days?
I don't define trend that way. I use the actually we use 2 moving averages. So, okay. But if you want a kind of a generic answer, and the reason I'm not giving specific, it's because it's part of the recognition software, is I would look at the immediately preceding move. So I'd be using 3, 4, 5 candles. So for example, here, to me, this would be like a neutral trend. This would certainly be an uptrend, short-term uptrend. This would be a short-term downtrend. This would be a short-term uptrend. Well, a bearish engulfing pattern, the market closes above it, momentum trade. Okay, for those familiar with swing targets, we're going to be looking at measuring targets tomorrow. You take the height of the move before the lateral band. This could also be viewed as kind of like a bull flag. Market moves up, and then you trade sideways. Now, this is one of those cases, remember earlier on we were talking about how do we know if with dozier spinning tops, it's not a pause before the market moves higher? You don't know that until after the fact. By the close above that resistance, that red resistance line, you knew it was just a pause before the market moves higher, but you don't know that until the market tells us that, right? And you take the height of the move before the rally and add it to the low of the correction to get a price target. Okay, here we have a bearish engulfing pattern trading the breakouts. So that the blue line is a resistance area. It held as a resistance, but the market closed above it. This is a nice momentum trade in spite of the black candle. It may be a little hard to see here, but there's a small rising window over there. Let me see if I actually, yep, okay. So the next session, the market pulled back a little, but did it hold the rising window as support? Sure. And I shouldn't say sure because many of you may not remember the window, how to use the window. But as long as the market closes above, it doesn't close below the window, this window is still support. And everybody see the window here as support? Another bearish engulfing pattern. Okay, but I don't know if this would be a good trade because you're looking at the window as support, so it's probably a poor risk reward. But nonetheless, a bearish engulfing pattern, the market gets above it again, a bullish breakout, momentum trade. Okay, here we have another bearish engulfing pattern. Did the market break above that? No, so you wouldn't be obviously doing any momentum trades. So as a general rule, remember the candle lines, you can use support or resistance, and if the market breaks the support area, if you're a momentum trader, you could sell it. If it breaks above a resistance area, if you're a momentum trader, you could buy on the breakout above it. Price confirmation, let's see what we have here, a lot of text. This is a less than ideal pattern for the bearish engulfing pattern. Why? Okay, let's look at the pattern. What about the size of these real bodies? They're about the same size, right? Remember the strict criteria. We want the first candle small and the second one really big. So this is less than ideal. And this is where you use the strict criteria. If you have strict criteria, in my opinion, you need less price confirmation. If you have a less classic or less perfect or less strict candle pattern, I would lean more towards the price confirmation. Make sense? Right? So this is less than strict here. So I would wait for confirmation. So the confirmation came with a lower close or even a lower move a couple of sessions later. but your risk is still, so, you got the bearish confirmation, which is great. So you got the bearish confirmation here, which is not bad. Still really good risk reward, I think. But your risk is still, remember, when you get the bearish confirmation, your risk is still to the high or the low of the pattern. You're still using that pattern as a resistance area. But that's a fine risk reward. My target would be down here. This would be my potential target, all right? But usually when I have something like this, where there's no support down here, I'll look at an intraday chart I mentioned before. I'll look, for example, at an intraday chart on this tall white candle to see if there's any support areas over here. I might also I'd be watching maybe change of polarity, see old resistance becoming support. So this would be my first support. This would be S1. But my more important, what we do with our institutional clients, actually, we put check marks under the more important support resistance areas. This would be S2, and I have a check mark by there. To me, that's a much more important support area. Okay, the same pattern, since the pattern confirmed resistance, the bearish engulfing pattern, there's less reason. Remember, if the candle signal confirms, question?
So if we would have gone short after that bearish engulfing pattern, we would have got stopped out 2 days later after that top shadow pierced. It went through the resistance, right?
Okay, great question. All right, when we talk about support and resistance, we talk normally on a close. Because a lot of times, and for those who are really active traders, you know that the markets will break resistance or support intra-session. A lot of times it's the floor traders trying, or the market makers pushing through it. It really has to close above the resistance area to say the resistance is broken. Same thing with the low of the hammer. It really has to close under the low of the hammer to say it's broken. So here we have a bearish engulfing pattern. Subjective, again, in my opinion, there's less reason for price confirmation because the bearish engulfing pattern confirmed a very obvious resistance area. You want to wait for price confirmation? No problem with that to increase the odds. So maybe you lightly sell in the bearish engulfing pattern and add to short positions as you get some price confirmation. But it depends completely on your trading style. Okay, now we're going to be talking at the opposite of the bull hat on me is the bear hat on me. And market's in an uptrend, and we have a tall white candle. The next session, small real body, black or white within the prior candle. Once again, 25% or less. And kind of the same rules as we were talking about before. The more, okay, for Forex, this is what it's going to look like in Forex, so we would definitely want price confirmation. The second candle is a small real body. That would be called a Hadermy cross. And not surprisingly, the more deeply the black candle gets into the white candle, the better the potential reversal signal, which you can't have in the Forex. This is what it's going to be like in Forex, so we do want price confirmation. Okay, so this is not, the first one is not a bearish Hadermy. The second one is, as is the one to your right. But because those are both hovering near the highs, I would suggest waiting for price confirmation by a move at minimum intraday under at least the close of the Hadermy. And you definitely need confirmation in Forex. These are all Hadermys. The red arrow on your left is a bull Hadermy. Notice how that small real body is near the bottom of the long black real body. That's the only way it could be with Forex. You want to wait for bullish confirmation. So at a move, as soon as the market gets above the close intersection, above the spinning top, a small real body here, you think about buying it. Obviously, if you wait for the close, it doesn't do much good, right? Because you're right near resistance. Here's a bearish Hadermy in Forex, no bearish confirmation. Everybody see that? Another bear Hadermy, no bearish confirmation. Another bear Hadermy, it's a doji, it's a Hadermy cross. Did we get bearish confirmation in the next session? Yeah, sure. Now this one, why would you need less bearish confirmation? This is a bear Hadermy, and it's always good in Forex or any market where the close is near the highs here. Doesn't matter if it's Forex or not. But why would we need less bearish confirmation? What is this candlestick signal confirming? A resistance area set by the what? What pattern is this? dark cloud cover, right? So it's always good with the Forex in any market, as I mentioned before, we have the highs holding very well to have bearish price confirmation. But if it's confirming resistance, you can think about starting to sell or liquidating long positions because you have an eastern signal confirming a western signal. Okay. Bear sash, and I'm going through these a little quickly because it's pretty much the opposite of the bullish scenarios. And I'm going to go through the basic criteria because this is one of the patterns I really haven't focused on before. Trend is not that important. Okay, it's a white candle followed immediately by a black real body that opens within the prior white candle. In other words, the market gaps down on the opening, and then the market closes as a black real body. Okay, the strict criteria is they're both long candles, and the black candle, it's important, the most important thing is the black candle closes at or near the lows of the session. Okay, the highest high of both candles become potential resistance, and we would consider buying on a breakout above the high of the pattern. Okay, can't have this in Forex. And not surprisingly, the more the market gaps down on the opening, the better the signal it is. Better insofar as more likely reversal. Keep in mind the risk-reward of this. It's the opposite of when we're looking at the bullish signal. Sometimes it's a bad risk-reward. Same thing here. It could be a poor risk-reward. And if the opening of the black candle is the same or lower as the prior line, it's a bear separating line. And we're going to look at that in a minute. So here we have a bear sash because the black candle, see the opening of the black candle, got into the white candle, and then continued down. Trend is not that important to the sash pattern because it's really showing a shift in psychology, even if it's an uptrend. Like here, for example, this is just showing that the bearish momentum is going to continue. Okay. Question?
Is there anything done on these that says that if such and such happens, that a percentage or a probability will be that this other thing will happen? Or is that not pertinent?
So you're saying, for example, let's say we have a bear sash. What's the probability of what, the market moving down or moving up? I don't know if if there is anything like that, but that's not the important thing. The important thing is you have a bear sash, let's say. What you should be saying to yourself is, it's not so much if the market's going to move down the next session, is it a good trade? Because if you have a bear sash and it's a bad risk reward, even if the market moved down the next session, you wouldn't have done the trade. So you can't really test candles in isolation. Okay, here we have changing to market circumstances, a little bull sash pattern, and then a couple of sessions later, a bear sash pattern, right? Okay, any questions on the sash patterns or the bear signals? And most of them are pretty basic, we talked about, but we went into more detail, with the engulfing patterns and so forth, and we'll review it in a couple of minutes. So, okay, we're now going to look at the bear separating line, and the market has a tall white candle. The next session, it gaps down on the opening to, now, the bull separating line, the openings are equal. The same thing with the bear separating line, the openings are equal. So what that means is that the tall white candle gaps up, moves higher, boom, the market sells off, opens at the prior opening, and continue. Now, it's no big deal. I mean, it's negative to open at the prior opening as long as the market bounces back, right? But it doesn't. It keeps on going down. So this is a bearish signal. Both real bodies for strict are long, but it's rare. To me, the most important aspect is that the black real body closes at or near its lows. You want to see a really weak candle. And, as shown in the handouts, we could, you can go through this in detail later, the highest high of both the candles is resistance, and consider buying on a move under the low of the pattern. So, not going to have this in Forex. An easy way to remember this is the openings are the same. They're separating. It's like going and, crossing each other. Actually, the Japanese literature compare it to strangers crossing down the road, going in opposite directions. So here, the openings are the same. not surprisingly, by the time you get the move, it could be late. Yeah, it could be over, exactly. So in this case, we don't know if this is a good risk reward because we have to see where our potential support area is, right? And trend is not that important with the bear separating line, by the way. So and it would be a bear separating line even if the opening is not, it has to be at least the same as the prior opening or even lower. So there's a bear separating line. This is a bear separating line also, over here. So in other words, this is a bearish signal here. You go here. So if the market gets above the high of this pattern, in other words here, it's a buy signal. Okay. Because the highest high of both candle lines is a resistance area. So if it gets above that, it's a momentum trade, it's a buy signal. Now this is a good bearish separating line. One, it's a fairly good risk reward. And two, what else did it do? Why do you think I drew that blue line? It broke through a support level, exactly. So this is one of those times where it may have worked out, just fine. Okay, so what we've learned in this section, just as we've done with the advanced double candle lines with the bull signals we did with the bear signals, we went through the 360-degree analysis. We went through the bear counterattack. So in other words, you have a white candle, the market gaps higher, and then closes about the same close as the prior session. Dark cloud cover, the black candle is getting deeper into the white candle, more than halfway. We go down some more, the bearish engulfing pattern. We looked at some nuances with the bearish engulfing pattern. We want a classic or strict engulfing pattern is the second candle, wrapping around the high-low range and other nuances we talked about. The bear separating line as the black real body got deeper into the white candle. We had the separating line. Then we have how some patterns, in other words, the separating lines and the sash patterns might be poor trade candidates because of the risk reward. Again, the same idea, but on the flip side of the bullish candle patterns. And the bear Hatteramy patterns, we want confirmation if the real body is hovering near the lows or near the highs, we want some bearish confirmation. We're now going to be looking at advanced windows. Okay, we're going to go over the basics of windows because some of you had asked questions about windows, so I want to make sure we're up to speed on it because it's my favorite candlestick signal. If there's any questions on this, just raise your hand, all right? Especially on the basic part, because I want to make sure we all understand at least the essentials before moving on to some nuances. Okay, this little highlight here, looks like my favorite candle signal. A rising window is the same as a gap in Western technicals. And this was actually the term that got me interested in candles years ago. I was working in New York, and there's a Japanese broker working down the hall, and she had a chart book from Japan. This is before anybody knew about candles in the West. And she had opened the chart book, and she gasped. She said, "We have a window." I said, "What are you talking about?" She said, "You Americans would call it a gap." I said, "What the heck are you looking at?" And she showed me her candlestick book, which she got from Japan. So that actually was the thing that piqued my curiosity. Anyway, a rising window is a gap is a potential support area. The window should be support, the whole window. Now, the reason I drew that dashed red line is because the lower the rising window, that is the major support area. If the market, it's only when the market closes under that rising window is the support broken. So this gets back to the question asked before. It's okay for the market to get under the window as it did here, as long as it doesn't close under the window. Okay, so this window that's shown here is still a valid support area. The stop would be on a close. The question is, what would I advise for a stop? It would be on a close under this red dashed line. Not an intraday move, but a close. But once again, you may get down here so much, intraday, there's going to be a point, if you're long, say some from around here, there's going to be a point where you say that you can't, stay long that much. And this is the problem with trading. It's like this guy goes to the doctor, and the doctor said, "You have 6 months left to live." And the guy said, "Oh my God, what should I do?" And he said, "Why don't you become a trader?" I said, "A trader? Why?" He said, "Because it'll be the longest 6 months of your life." And actually, he couldn't pay, so the doctor gave him another 6 months. The Most important support is the bottom of the window. That's the last gasp of support. And not surprisingly, a falling window, a gap down, becomes a resistance area. The whole zone of the window is resistance. The top of the window is the major resistance area. Now, the challenge with a large window is we have a really huge potential. In this case, a rising window. We have a really big support area, right? And this is why I like small windows like we have here in Home Depot. That tiny window gives us a much tighter support or resistance area. So I really like small windows, as you may have known from my prior seminars. So here we have a shooting star, and you see that green W? Okay, the W there may be a little hard to see. That's a rising window, and that's what's great about the recognition software. You may not have visually been able to see that because it's such a tiny window, but a window is a window is a window. It doesn't matter how small it is. So although there was a shooting star, we would not sell there, and especially, and this may have been the same chart we looked at before, was there any price confirmation of the shooting star? No, the next session the market moved higher. So 2 reasons not to be on that shooting star. Okay, here we have a falling window, and what do we have here? What do we have there? Okay, we have a window, but what do we have? A series of doji. So I don't want anybody to say how much is that doji in the window. I don't want any of that. I did not say that, all right? All right, so does anybody even remember that song, right? How much is the doggy in the window? So, so here we have a doji confirming the window's resistance, and if you were bullish, you might have this kind of expression, okay, little little frown over there, all right? So the doji is showing us that the market is stalling right at the window's resistance area. Okay, let me show you a nuance, and this gets back to the question about the rising window. If there's okay, first of all, let's look at Google here. And the blue arrow, what do we have? 2 candlestick pattern, piercing pattern, great. And it's confirming a rising window. Right? Now the market rallied higher. Obviously, with a gap like that, it's news related. Okay, so that worked out well. That was luck. Okay, although we're getting bottoming signals there, a rally like that is obviously, as I mentioned, news related. Now the small, see how nicely the small windows worked out? Those green horizontal lines. Those are easier because you have a very tight support area. The challenges with the rising window, let me show you one of the things you could do, a little advanced, what you could do with a rising window. You could this is a big rising window. My first support area, and this gets back to the question, is the top of the rising window. That would be my S1, my first support. Not major, but it's my first support area. The challenge is, there's nothing, I've tried 50% corrections in the window, that doesn't work. The next support area I would have would be at the bottom of the window. It doesn't mean the market's going to, it doesn't mean the market's going to go down to S2. The market will get to the middle of the window and then rally. But as far as official support areas, those are it. And my check mark, my most important support area would be at S2. But at times, the top of the window becomes support. Minor support, but this is the only way you could really think about trading with large windows, because this would be S1 and then S2. So for example, here, there's a big gap on the downside. Now we know the major resistance is R2, it's the top of the falling window. Everybody see that? But we could make R1, once again, not as important as R2, but the top of the beginning of the window becomes R1.
I just wanted to clarify. So if we had either a rising or a falling window, and we had some other form of resistance or support lines, would we be able to use those as an interim?
As an interim for...
In other words, if something like, say we had a longer term chart, or maybe we had done a Fibonacci on that, and one of the lines of retracement fell in there, could we use that as sort of an interim or something to take a look
Fell
at?
within the window, you mean?
Yes.
That's a great point. Okay, everybody hear that?
Sorry, I
there
wanted
might
to
be
make it more
something else
clear.
that you're looking at that, and I didn't think of that. That's a great point. That there might be something else that you're looking at on the Western technicals, a downward sloping trend line, Fibonacci retracement, something else that may give you a resistance area within the window. It's a great point. but it would be a Western charting technique. It wouldn't be a candle charting technique. And that's a great way of finding potential resistance, especially, or support in a really large window. Okay, and this gets back to a question before, challenges. Okay, when a rising window is substantially broken with a close below the window, does that rising window now become resistance? Change of polarity. Okay, and Brian sent me this email. And let me go through this. Let me just refresh your memory. Anybody want me to go over change of polarity? Just very quickly. Old support becomes resistance. Okay, old resistance becomes support. Simple as that. All right, and the support has to be, the only nuance that some people don't remember is it should be a multi-tested support area. Just one support doesn't do it. It should be tested at least 2 or 3 times. The same thing, resistance should be tested multiple times. Change of polarity, old support becomes resistance. So with that, let's get back to Brian's question. Okay, when a rising window is substantially broken with a close below the window, now remember, a window is only broken when the market closes below it. So when the market closes below the rising window, let's say it does it here, does that rising window, because what Brian's saying is a window is support, right? And change of polarity, old support becomes resistance. So what he's asking is, if the market is broken, if the window is broken, does that support area then become resistance? Okay, and the answer is, it depends. It all depends. It depends completely on how often that window is tested, right? In this case, the window was only tested one time. I would not use change of polarity. If it was tested numerous times, I would use the change of polarity. And it's a little bit of a nuance, but the window is the thing that's causing the support, but it's not the window that we're using the change of polarity. So in other words, it doesn't matter why there's support here. It could be a window, it could be a pivot low, whatever it is. As long as the support area is tested a couple of times, we use the change of polarity. So it's the change of, it's the testing of the support area that makes it the change of polarity. It may have, the support may have held because of the window, it may have held because of something else. But the point is that if you have a rising window and it's tested more than once, then we could use the change of polarity. If it's not, we don't. And the same thing with resistance. So here, for example, here we have a falling window. We see how the falling window became a resistance area, right? When the market closed above it, we then could use change of polarity only because that resistance area was tested numerous times. So the window may have been the root cause of the resistance, but the actual idea of change of polarity is dependent on the number of times that resistance was tested. Everybody clear on that? Okay, great. Island tops and island bottoms, great in Western technicals. The market gaps up and gaps down. And what we're going to do here is, once again, getting a jump on the competition. So, with an island top, to refresh your memory, the market makes a gap higher and then gaps down. It could be one session, it could be numerous sessions, and it looks like an island surrounded by water. And an island bottom is the flip side. Now, in Western technicals, and I like islands, they're really good longer-term signals. With Western technicals, this because in the West, up until my stuff, people didn't look at gaps as resistance. So this would be the first resistance, but with a falling window, with the island top, what becomes our first resistance? The falling window. So I would have this as R1, the horizontal blue lines is R1, and R2 would be the horizontal red line. Now we're getting a potential resistance area that those in the West don't have. Same thing here. An island bottom. In the West, they would have this as first support, but now that we know about windows, this is our first support. So let's look at this in the real world here. In the blue arrow, everybody see why that's not a piercing pattern? The blue arrow? And why is that? Right, exactly. The white candle doesn't get more than halfway in the black candle. Second one is, everybody agree, is a piercing pattern, right? Okay. And by the way, so we have two, although the first one is in the piercing pattern, in both instances, we're seeing a shift in psychology from black real bodies to lack of follow-through on the downside in 2 out of the 4 sessions. Okay, the market had gapped higher and gapped lower. Okay, so we formed an island bottom on this session. Everybody see that? Okay, because the market gapped down here and gapped up here. So here in the West, we would have first support at S1, but obviously, where's first support? At the rising window, right? In the green line. So if the market, of course, broke under those green lines of the rising window, my next support would indeed be the low of the island bottom. So it's not as though I don't use that. It becomes my second support area.
When do you buy here, and would that be a good reward ratio?
Okay, would that be a good risk reward? We can't tell. We know what our stop out area is, close if we bought it here. And here, normally I said a doji in the downtrend, although there's not much of a downtrend and I don't pay too much attention to. I would here because this is a doji showing us the market is separating from its bear trend. Bears, now the market's neutral right at the window. The challenge becomes, what's our price target? We know what our stop is. We'd have to go back here to see what the recent highs are, to see what it is. But based on this, it looks like a pretty good risk reward because I don't see any resistance, and at least through here. And the opposite here, an island top, a small gap on the upside here, and a small gap on the downside. So in Western technicals, whoops, actually, this should be R1 over here. This would be R1 over here, okay, in Western technicals, but with us, R1 is with these green lines because of the falling window. Okay. Windows and confirmation. Okay, this is a bit of a challenge because here we have a very small window and it closed under the window by 2 and 9 cents. And the very next day it opened above it. So this is subjective. You're going to have to say to yourself, if it closes, I know I would be thinking that, hey, it'll close on by a couple of cents. I would want to see the market continuing lower to confirm that breakout, the break under the support, because it's such a minimal break of support that to me it wouldn't be that important. So I would want a little bit more price confirmation on that. Okay, 3 windows. Okay, in my book I talk about, and just echoing the Japanese information about 3 rising windows. The Japanese would say the market is vulnerable to a correction. The feeling is, and I can understand this, the first window is new buyers, the second window is other new buyers, and the third window just might be those, kind of like the final blow-off. But to me, from my experience, the windows are so absolutely powerful, it doesn't matter how many windows you have. You could have 3, 4, 5, 10 windows. It's only when the top window is broken do we really see a change in psychology. So here, for example, let me go back here. So here in RIM, we had a series of rising windows shown by the red arrows, but it was really, this happened to be 4 rising windows. But it was only after the top rising window, the 4th rising window was broken, that we could say that the window's support area or the market's momentum is now broken, the bullish momentum. So there's no magic about 3 windows. It's only if after the top window is broken do we pay attention to that. Okay, another nuance. Okay, using intraday candle charts to refine entries with windows. And this works really with small windows, and I'll explain why. Let me go through this. For small windows, or when at the bottom or near the bottom of a large window, we could look for an intraday. Now, this is for those who have access to intraday charts, during the session. A lot of you work during the day. But we could look for intraday candle reversal signals. Let me show you this strategy. It's neat. On the left side, we have a daily chart. The dashed red line is the bottom of the rising window. We can see how that rising window held the support, right? We don't know that, however, until the end of the session, because the market could be trading over here, and by the end of the session, by the end of the session, if it closes here, we're through the window. So we got the confirmation of the window over here. Okay, we wouldn't be buying it, by the way, here, because although it's at a support area, there's no turning signals. So by the time you got the confirmation with this bullish engulfing pattern at the rising window, the stock, in this case BMY, was at $31.60. What you could do is, and this is related to using support or resistance on the daily chart and use it at an intraday, what we could do is take the bottom of that rising window on that daily chart, throw it on the intraday chart, and that's what I did on the right, on your right, and this happens to be a 30-minute chart. And what pattern did we have confirming the window on the intraday chart? Bullish engulfing pattern, right? Now remember, with the candlestick line, we need open, high, low, and close. Nothing saying we can't use the close of an intraday chart. So by looking at an intraday chart as it's approaching the bottom of the window, we've now said, okay, we have a bullish engulfing pattern at the bottom of the window on this intraday chart. So essentially, we got a turning signal at $31.15, opposed to the fact if we just waited to the end of the day where the turning signal would have been $31.60. Isn't that neat? So using it at intraday to refine confirmation of a support area set by the bullish engulfing pattern. Okay? Now, the reason this works better at small windows or at the bottom of a large window, let me go back here, is because what's going to happen if you have a really big window, let's say you have a $2 window on a $40 stock. You have a $2 rising window. As you're moving down, you may get bullish candlestick signals, but the market may continue moving down. The only time I would pay attention to bullish candlestick signals on an intraday chart is not within the window itself. It's only as it gets near the bottom of the window. Everybody see that? Because the bottom of the window is the important part. So if you have a really big window, you may get bullish, you may have hammers, bullish engulfing patterns, but it really only becomes important if it's near the bottom of the rising window. And that's why this works on the bottom also I should say, that also works on a small window, because you have a tighter support area. So a little nuance over there. So let's wrap up what we've done today. We reviewed the window basics, my favorite signal, rising window is support, falling window is resistance. Large compared to small windows, the tighter the window, the tighter the time frame, the better the support resistance area, the tighter. When you have a large window, okay, we could use, if you have a large rising window, you could use the beginning of the window as first support, minor. The more important support is the bottom of the window. Same thing with resistance, a falling window. Use the bottom of the falling window as your minor resistance. The major resistance is the top of the falling window. Change of polarity in windows. It's not the window itself, but it's how often that window support or resistance is tested. Only then can we use change of polarity. Island tops and island bottoms. Okay, we now have a way of getting support or resistance before those in the west because we're using the gaps as support or resistance. And confirmation with intraday. So if we have a window, if we're getting to the bottom of the window, for those who are at the charts near, as it's happening, it's a great opportunity to see if there's any bottom reversal signals with that. So we've now looked at the candles, advanced candles. We reviewed the basics very quickly. We did a lot of new nuances now. The next step is going to be learning how to use the candles. As I mentioned before, we now know how to recognize the strict candles. The more strict the candle signal, the better the likelihood of the trade. We learned how to use them for momentum trading and support or resistance. Now the next step is progress into using candles with Western technicals and then completing the circle or completing the triangle with trade management. So that wraps it up for now. Great.